Picture this. You open your mailbox one morning and there it is. A letter from the IRS. Your stomach drops. You're on SSDI, you're not working, maybe you have a part-time job here and there, and now the government wants to talk to you about taxes. Most people in that situation panic. They assume they owe money. They assume they did something wrong. Some people don't even open the letter. Here's what I want you to hear right now. Most people receiving disability benefits don't owe a single dollar in federal income taxes. Not 1 cent. But, and this is the part that frustrates me every time I talk about it, most people on disability also leave thousands of dollars on the table every single year. Real money. Money that belongs to them, because nobody sat down and explained the rules. That changes today. I'm Drew, this is Disability.co, and this episode is your complete guide to disability and taxes. We're talking about what the IRS actually taxes, what they don't, and every deduction and credit you probably didn't know you qualified for. There is so much more for us to cover in this episode. So, without further ado, let's get right into it and start today fresh.
The first question everyone wants answered is simple. Does the government tax my disability benefits? The answer depends entirely on which kind of benefits you receive, and there's a very important line between the two main programs. If you receive SSI, Supplemental Security Income, the answer is no. Full stop. SSI is never taxable. It does not count as income on your federal tax return. The IRS has confirmed this clearly. If SSI is your only income, you almost certainly don't need to file a federal tax return at all. You can stop worrying about that one. SSDI is a different story, and it's where things get a little more nuanced. SSDI can be taxable, but only if your total combined income crosses certain thresholds. The IRS uses a specific formula to figure this out. Here's how it works. Take half of your total SSDI benefits for the year and add that to all your other income, wages if you're working, investment income, pension payments, everything else. The result is your combined income number. Then you compare it to these thresholds. If you're filing as a single person and your combined income is under $25,000, none of your SSDI is taxable. Zero. If it falls between $25,000 and $34,000, up to 50% of your SSDI could be taxable. If it goes over $34,000, up to 85% could be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. Let me make this concrete with a real example. Let's say Maria receives $1,400 a month in SSDI. That's $16,800 a year. Her husband earns $28,000 from his job. To figure out their combined income, you take half of Maria's SSDI, which is $8,400, and add that to her husband's $28,000. That gives you $36,400. That's over the $32,000 joint threshold, which means up to 85% of Maria's SSDI could be considered taxable income. But here's the key word, could be. We'll come back to Maria in a moment, because with the right deductions, they may owe nothing at all. Now let's talk about something that trips people up all the time. Lump sum back payments. If you just got approved for SSDI after a long wait, which is extremely common, the SSA may have sent you one big payment covering months or even years of back benefits. If you drop that entire amount into the current tax year's income, it can look like you made a lot of money this year and push you into taxable territory. What most people don't know is that you can use something called the lump sum election method. Essentially, you elect to spread that back pay across the prior years it was actually owed, which prevents it from inflating your current year income. You report this on Form 1040. The IRS has a specific worksheet for it. And critically, you do not need to go back and amend old returns. The IRS handles this through a calculation on your current year return. Every January, the Social Security Administration mails you a Form SSA 1099. This is your benefit statement. It shows exactly how much SSDI you received in the prior year. You need this to file your taxes. If you haven't received yours or you lost it, you can get it online through your My Social Security account. And if you do expect to owe taxes on your SSDI, you don't have to wait and pay a lump sum in April. You can set up voluntary withholding by filing a Form W-4V with the SSA. You choose how much to withhold, 7, 10, 15, or 25%. It goes straight to the IRS throughout the year, so there are no surprises at tax time. Before we get into specialized deductions, let's talk about the standard deduction, your first line of defense. For 2026, it's $16,100 if you're single, and $32,200 if you're married filing jointly. If your taxable income falls below those numbers, you owe nothing. If you're blind, you get an extra $2,050 on top of that if you're single, $1,650 if married. And the IRS definition of blindness includes significant visual impairment, not just total blindness. If you're blind and 65 or older, you stack both additions. One more thing for anyone 65 or older. The One Big Beautiful Bill added a $6,000 extra deduction per person for 2025 through 2028. Married and both qualify? That's $12,000 more. For most people on fixed disability income, this alone can bring their tax bill to zero. Now, the medical expense deduction. If you itemize on Schedule A, you can deduct medical expenses that exceed 7.5% of your adjusted gross income. That includes prescriptions, doctor visits, wheelchairs, hearing aids, home health aids, therapy, and transportation to appointments. Here's the one people miss: home modifications. Ramps, grab bars, stair lifts, widened doorways. If your doctor recommends them for your specific condition, and they don't significantly raise your home's value, they're deductible. Get a letter from your doctor and keep every receipt. Last in this section, impairment-related work expenses, or IRWs. If you work while on SSDI or SSI, costs you pay out of pocket to be able to work can reduce your countable earnings below the SGA limit of $1,690 per month in 2026. We're talking service animals, specialized transportation, prosthetics, attendant care, medical devices. Has to be unreimbursed. If insurance covers it, it doesn't count. And if a disability attorney was paid out of your back pay, that fee is deductible too. Deductions lower your taxable income. Credits are better. They cut your actual tax bill dollar for dollar. The credit for the elderly or the disabled, Schedule R, is worth between $3,750 and $7,500. It's for people retired on permanent and total disability with taxable disability income. Non-refundable, but it can zero out your remaining tax bill entirely. The IRS worksheet on Schedule R walks you through it in minutes. ABLE accounts are one of the most powerful tools available, and 2026 brought a huge change. An ABLE account is a tax-advantaged savings account for people with disabilities. Contributions grow tax-free. Withdrawals for disability expenses are tax-free, and up to $100,000 is excluded from the SSI resource calculation. That means it doesn't count against your $2,000 asset limit. The 2026 annual contribution limit is $20,000 from all sources combined. And starting January 1st, 2026, the eligibility age expanded from 26 to 46. If your disability began before your 46th birthday, you can now open an ABLE account, regardless of how old you are today. That opened the door for millions of people. Also worth checking, the Earned Income Tax Credit. If you have any earned income, part-time work, self-employment, the EITC can be worth thousands and is refundable, meaning you can get a check back even if you owe nothing. Here are your 6 action steps. 1. Locate your SSA 1099 online through My Social Security if you lost it. 2. Add up all your out-of-pocket medical expenses from last year. 3. Document any home modifications or work-related disability expenses and get your doctor to write a letter. 4. Check your ABLE account eligibility, especially if you thought you were too old. 5. Use IRS Free File if your AGI is under $89,000, or find a free VITA tax prep site near you. 6. If you got a lump sum back payment, ask about the lump sum election method before you file. It can save you a lot.
The tax code has real protections built in for people with disabilities. The thresholds, the deductions, the credits, the ABLE accounts, they exist, they're legal, and they belong to you. The problem was never that the rules weren't there. The problem is nobody explained them clearly. That's what disability.co is here for. Drop your questions in the comments. I read every single one. Take care of yourselves. We'll see you in the next one.